Okay, so here we are, almost 30 days into the quarter, and we already have some interesting things to talk about here. Couple things that we're gonna get to this hour. Obviously, the rocky start to the beginning of the year. A lot of volatility in the markets. Obviously, we've all been paying attention to that. We're going to talk a little bit about the macro trend, as I like to call it, kind of an underlying economic trend that sort of dictates generations of how the economy and markets move. The hot topic, and probably one that is likely to stay, but we'll talk about that, is inflation. And what that means for interest rates, and then we'll go through what it means for portfolios, for planning strategy. How all of these apply, to investments. So we've started off January pretty dry, and
you think?
Yeah. And this data is as of, I think it's as of Monday, but we've had a little bit of gyration since then. So these are still pretty close, these numbers. But a couple of things I just wanted to call out here, Rick, and and then I'll let you chime in. We have kind of two different pieces here. So there's the S&P 500, broad measure of equity markets. U.S. equity markets down 7.7%, worst monthly performance basically since COVID. And then there's really two things to look at here: the S&P equal weight, and the reason that's on here is because the S&P is market cap weighted. So all of these big tech names that have run up substantially, as they run up, their market cap gets larger and larger. Therefore, they make up a larger piece of the index. So the equal weight is actually not down quite as much, and it's the same. It's not on this chart, but the same is to be said of the Dow. And then you can see the NASDAQ and the S&P Information Technology Index are down even further. So we have a pretty wide dispersion between tech and everyone else. And obviously those tech names, as you can see, the NASDAQ and the S&P Information Technology Indexes, those are the worst monthly performances since 2008. So this may be a...
And that NASDAQ actually dropped the other day when the market had dropped down. That touched on negative 18% at one point throughout the day when we had a lot of volatility. So it ended up closing on a positive that same day, but it did have a lot of volatility to it, and it will continue to have a lot of volatility to it.
Yeah. So I mean, the FANG stocks have proven to be pretty resilient. Since the Great Recession. Facebook, Apple, Amazon, Netflix, and Google, have proven to be incredibly resilient, although volatile, since the recession. And this may represent somewhat of a turning of the tide, because while they are typically volatile, we think this may be an indicator of things to come. And here's why I say that. So I want to just explain these charts that are up here. They look a little confusing, but they're actually saying something incredibly simple. If we look on the right-hand side, these are interest rates, federal funds rate, over the last 50 years. And we can see, back when mortgages were 15% in the early 80s, rates were at a high. And today, in fact, really since the recession, rates have been pretty much near zero. And that's still the case today. So it is a long-term trend down. Rates have just been getting lower and lower and lower and lower over time. What that means is that debt levels have been getting higher and higher and higher and higher. So all debt levels, pretty much from any way you slice it, household balance sheets, corporate balance sheets, they're all at record levels. In fact, have been at record levels, since 2008. So we just essentially just keep adding more debt onto the pile. And the long-term debt cycle, which is what the chart on the left is attempting to illustrate, essentially states that economies operate in these incredibly long-term debt cycles, right? You think of a 30-year mortgage, that's an incredibly long-term piece of debt. And these long-term debt cycles are marked by basically changes in the way that currency is handled. So, back in the 70s, we went off the gold standard, and then there has been since then a period of incredible leveraging, just continuing to add to debt, and rates just keep going down and down and down and down over time. The point being is we are at what they would call in this theory of the long-term debt cycle, a debt peak. And we have been at a debt peak for quite some time. So when you're at a debt peak, a couple things can happen when you get issues in the market, like a subprime mortgage crisis, or a pandemic shutting down the economy. Either the market crashes, and since there's no more debt to be had, the other thing that can happen now, which is something that they never had in the past, is they can just decide to make more money, make more currency. And during COVID, and we talked about this last quarter a little bit, in the quarters before that, the Federal Reserve created about $5 trillion of liquidity. And that is really the major factor in where the market is going, because most of that liquidity, is still sitting on the sidelines. Most of it didn't go to really prop up business at all. It's sitting in, technically sitting in Americans' bank accounts, whether it's in from investments, investment returns, or what have you. There's extra cash sitting on the sidelines, and the point is that instead of paying for this through more debt, when the liquidity tide goes out, that's when inflation goes up, because you pay for all of that money creation through inflation. And that's why we're starting to see the green shoots of that popping up last year. So I'm just going to pause there really quick, because that's a lot of stuff to digest.
So Dan, we talked about that a couple of times in the letter. You've written about the theory of unlimited money a couple of times in the letter over the last couple of quarters. When does money become infinite? I mean, they talk about it. Now, you also mentioned the money multiplier a couple of times in our past quarterly reviews. When interest rates get down to a zero level, they talk about money becoming unlimited. Expand on that a little bit.
Yeah, the theory of unlimited money is essentially this: a sovereign nation who mints its own currency can never default. That's, in a nutshell, the theory of unlimited money, that a sovereign nation that mints its own currency can just create more and more and more and more and more of it. And the reason I bring it up in the context of the long-term debt cycle is because, again, these long-term debt cycles tend to be marked by changes in the way that currency is handled. So the original cycle, going back to the pre-industrialization era, would have been the Bretton Woods Agreement, when we went on the gold standard. And then, that cycle effectively ended when Nixon took us off the gold standard. And that's still the cycle that we are currently in. So the argument would be that when you have a central bank that starts to operate on the theory of unlimited money, quantitative easing, what Ben Bernanke wrote his thesis on, and I know you talk about that a lot, Rick, and we put that into place after the great financial crisis. That was the first time that's ever happened, that we actually just went in and started creating fictitious money, so to speak, since we went off the gold standard, because we were at that debt ceiling. There was no other way to get out of it. And the point is that creating this sort of fictitious liquidity, this unlimited money, is a vastly different concept to currency manipulation than what we've essentially been operating off of since we went off the gold standard. So it would suggest that, and this is not an exact science, because this is a long-term cycle, right? So I said we've been at a peak really since the subprime mortgage crisis. When we started to kind of get out of it, rates started going up in late 2016. They started inching their way out, and then COVID happened, and they just threw us right back into the fire. We've been at that peak for a while. So this is one of those things where the theory of unlimited money would essentially say that the Fed can just keep creating money, and again, eventually doesn't mean it has to be this year, doesn't mean it has to be 2 years from now, 3 years from now, but eventually that gets paid for through inflation. And we'll talk about this a little bit, but obviously with inflation, you have to combat that with rising interest rates. Rising rates mean that debt levels will go down. So at a certain point, it has to happen. We just don't know when.
That's the big question. And let's talk a little bit more about the unlimited supply of money at this point, because you mentioned Ben Bernanke's thesis. He did his thesis on the depression of 1930s, 1929, the crash in 1929 and 1933, when the depression existed. And what happened there was we had a stop in the money supply. Basically, the market crashed. The bank's reserve ratios dropped, the multiplier, or the what do they call it? The money multiplier dropped down, and people started pulling their money out. And the fact that they pulled their money out of the bank caused that money multiplier to drop down, eliminated banks from being able to lend money, eliminated a lot of banks to begin with, and basically stopped the production, so to speak, of money, where once the banks started going out, then people stopped buying, businesses stopped being able to produce, manufacturers stopped being able to manufacture, and basically put just a wedge in that circulation of money, and wouldn't allow it to grow anymore. So Ben Bernanke's theory behind this, and he's written numerous occasions on inflation targeting and how to prevent the 1929s, 1930s all over again, basically was to keep that supply of money growing. That's why in 2007, they called him helicopter, or actually it was 2008, they called him helicopter Ben, literally throwing money out from the helicopter, being able to supply as much money into the system as possible, which was a much needed situation, because we had some bank failures at that point in time. And we couldn't allow that circulation of money to stop. In this case that we're in right now, where they threw another $4 trillion out, or more than that, I believe it was. $5 trillion.
Yeah.
was when they stopped the economy, when COVID hit, and they basically tried the same philosophy as basically throwing money out to the system, where our system really never stopped at that point in time. It was just people stopped working. They threw money into the system to keep people afloat, and the buying continued, and more money continued to flow out into the economy. And now we're just sitting on it. So, but Ben Bernanke's theory or philosophy behind that is just not to stop the flow of money. And I think this time is a little bit different, because the money's out there sitting and is being spent on different things, basically housing and everything else that's causing the inflationary environment to exist at this point.
Yeah, and I think, and that's why you see with inflation here, and I wanted to I wanted to draw the corollary to the long-term debt cycle, just specifically because um, there's two, I mean, there's a lot of different inflation metrics, and they've actually created more just to sort of explain away different different price shocks. And I think Rick has a chart on this too, which we can share. But the two that I wanted to share, because they have a really long-term history, is you know, the consumer price index. I mean, we all are somewhat familiar with that. Which actually, interestingly, the consumer price index does not include housing costs. Just a little side note. But essentially, the consumer price index is what most of us would refer to as headline inflation. So when they say, you know, inflation was 7% last year, that's what, you know, that's what they're referring to. There is another sort of amended metric called the sticky consumer price index, which is less food and energy. And really, the reasoning is that food and energy are just seen as a little bit more volatile, and you can sort of see it in these charts. The red line, the headline inflation, tends to be a little more volatile with food and energy, and the sticky inflation, which is a term you may see used out there in different news articles, tends to run a little bit smoother. Now, in periods like the 70s and early 80s, you know, the sticky inflation was right up there with the headline inflation, and that was obviously a problem. And that inflation was really the reason that rates went so high, was because without sort of choking off that inflation, it would just continue to run rampant. And the reason I pointed out is because in 73 is when we went off the gold standard. So it was a massive currency manipulation. And in 73, it was really the last time that we saw a dispersion between the headline inflation and the sticky inflation by this magnitude. So the headline inflation last year was twice what the sticky inflation was, and in 1973 it was just shy of twice what the sticky inflation was. But when that headline inflation pops up and both of them are moving in that direction, the point is that this is indicative of a major shift in the way that the currency is being valued. And because of this, right, we have a couple of things to look at here. You know, obviously you can see, by the way, these shaded areas are recessions. You can see that after 73, you know, we were thrown into a recession, and then inflation took off again, and that's where rates had to be risen. You know, the question here is really, and this is obviously something that, you know, we don't have a crystal ball, but this is sort of what to pay attention to. How sticky is the sticky inflation, number one? And number two, at what level is that inflation going to stick? Right? I mean, and Rick and I have talked about it. Like, we don't anticipate inflation staying at 7%. You know, but 3%, when it's been next to nothing, is a substantial change. And with all that cash still sitting on the sidelines, it looks like there will be sustained inflation, but we have to sort of take it with a grain of salt, because coming out of last year, we were, you know, dealing with supply chain issues. We had, you know, used cars that were jumping up 20%, stuff like that. So we don't think that's going to continue, but we do think, you know, 3 to 3.5% is, you know, over the next 10 years is going to be a much bigger deal than 1% or less than 1% over the last 10 years.
I was just trying to pull up that chart you were talking about, but I'm not as technically inclined as you are in that respect. But that was a great chart because one of the sticky parts of inflation you were talking about is rents. Where housing prices have gone up, property values have gone up, rents have gone up substantially. I think over 15% over the last year.
Yep.
And that is a piece of inflation that's here to stay long term.
Yeah. So I think that this is really the important thing to realize of really what this means. When that inflation wave comes in, the authorities are going to respond, and this is the ironic thing, because it sounds, I feel like the tone of this sounds a little bit apocalyptic, but it's not. It's just essentially a shift in the tide of the market from what we've been used to with, near zero rates since the Great Recession, and just tech stocks booming, and PE ratios just staying at all-time highs, and debt levels continuing to climb. The actual objective here is to move rates off of zero. The actual objective here is to create some level of sustained inflation. We certainly don't want inflation like the 70s, but the goal is to create some sustained inflation. What we're looking at here is what the Federal Reserve expects to do with interest rates. And the way they do it is they do essentially a 3-year horizon, and then what they call longer term. So the longer term is, and each of these dots, these yellow dots that you see on this this chart, represents a single vote of one of the Federal Reserve's board of directors. So in 2021, last year, they were unanimous. We're keeping rates at zero. Now, heading into 2022, you can kind of see, the consensus, where the consensus opinion is. They tend to have a consensus for this year, and they tend to have a consensus for longer term. But what happens over the next 2 to 3 years is kind of all over the map. And here's why that's important. Two things to think about. One, when they do a rate hike, it's 25 basis points at a time. Typically, the Federal Reserve meets what, Rick, 7 times a year, I think, 6 times a year.
6 times a year, I believe.
So an aggressive rate hiking schedule would be 6 to 7 times a year. A more moderate rate hiking schedule would be 3 to 4 times a year, which is what they are expecting for 2022. The thing is that longer term, over the next 2 to 3 years, this gray line represents what the market thinks is going to happen. So the market is undershooting what the Federal Reserve chairs have stated they believe to be their objective. And what happens is, this is why when you have the Federal Reserve coming out releasing their meeting minutes, and in this most recent one talking about potentially tightening, in other words, taking money out of the economy, talking about starting a rate hike in March, whereas initially it was expected in June, you're going to have, along the way here, you're going to have a market that expects rates to be here, and it ends up going here, and it kind of goes along this curve. So what ends up happening is the market sort of corrects along the way, as expectations versus reality don't always match up. So that's why you have, when the Federal Reserve comes out at the very beginning of the year, incredibly hawkish, when we weren't really anticipating it until mid-year, the market will react harshly, because that essentially sends a signal that the Fed, in all their infinite wisdom and economic research, believes that they need to increase rates to start choking off some of the inflation. And they believe that they need to get off of that zero sooner than later. Whether or not that's the case, whether or not, a rate hike would be, there's essentially, like, policy mistakes can happen, right? Like, you could have a rate hike too quickly, You could have too much liquidity created that creates too much inflation, but this is essentially the Fed's plan to dig themselves out of the hole that they created.
And I think Jerome Powell is, he's kind of sitting on his hands a little bit. I think the market believes he's a little bit behind the 8 ball at this point in time. I think he's still sitting on his hands a little bit. And this is where you and I kind of agree to disagree at some points in times where, I still believe that we're in a transitory environment. You believe that we're a little bit more in an inflationary environment, which I do believe we're in an inflationary environment. But, I think that we still have some transitory behind us.
Yeah, I think that I tend to think that based on everything I've been reading and hearing, that we've and I do have a chart for this, but I'll kind of just explain. We've been
I have a chart for everything.
Inflation has been running below its long-term trend since the Great Recession, and most of what we're hearing is that it's going to revert back to its long-term trend, which would mean that it has to increase. Now, the 7% inflation is likely to not continue. That's the good news. But with sustained inflation, it does mean rates continuously increasing, and therefore the market reacting to, the Federal Reserve's press announcements and minutes and their tone versus expectations. And it also means that there could still be, to your point, Rick, like there could still be transitory pockets of inflation, because there is a lot of cash still out there. So when you have a lot of cash, I mean, I can't explain exactly why used autos didn't have the necessary supply chain to meet the demand, that they were presented with in 2021. But that could rotate to different sectors, to different products, to different goods.
Yeah, it's basically the capacity of plants and the chip manufacturers and COVID, where COVID hits a plant and you all of a sudden you lose your capacity to produce for a period of time. It happened in the meat packers where Tyson Foods dropped down to 70% of capacity or 78% of capacity for a period of time. Right. The chip manufacturers overseas, and this is why what's his name from Tesla, he's manufacturing his own chips, never ran into that issue. Elon Musk, yeah, so he never ran into that issue of manufacturing because he manufactures his own chips. But this is why the used car prices are going up so aggressively, because the amount of new cars are on back order, mainly because they can't get parts to push the new cars out in the market.
Right.
But yeah, so go back to, let's talk about inflation just a little bit more, and then we got to keep moving because we'll be running out of time. So
yeah,
go back to that one chart in the beginning. Just want to touch on something here.
Sure. I want to talk about what this means for portfolios, but this
keep
one.
Going back one more. Nope. Okay. One more. Where it showed long-term trends. I guess this is interest rates you're talking about, right? So
yeah.
Let's see if I can pull my annotation device down here. So you got periods of time where we had aggressive moves in interest rates that occurred here, and this is when inflation was moving quite quickly. And then every time we came back down to a little bit higher of a high. I think where the Fed's looking now, the number of tools that they have available to them besides just interest rates, and you'll hear the quantitative easing where they're not buying, they're not buying as much bonds on the market. They're going to actually end that in March. They got an interest rate tool where they can start pushing interest rates up. We don't think they're going to happen at this level. But they also have the ability to reduce their balance sheet and push more money out push more bonds out onto the market. That kind of reduces the supply of money at the same time. But the most important thing, I don't think we're going to this level of jump in inflation or jump of interest rates. So we're going on a trend, and I think it's important to understand that we're going on that trend. And there's a lot of changes we're going to talk about coming up in the next couple of slides that I'll let you run into before we run out of time, Dan.
Yeah, let me go into the investment themes, I think. And again, and that's the other thing too, is we have to remember is it is their objective to raise rates. But to your point, they don't want to have to do that. They don't want to have to precipitously increase them.
Right.
So that's the other thing. You're probably going to read a lot about this. You'll see it in articles and headlines. The Fed's soft landing, as it's been called, is essentially, they've dug themselves quite a hole with creating this much liquidity. They've made their bed, now they have to lay in it. They want inflation. They've been falling short of their target for a long time. We want to get off zero rates. And now it looks like all of this extra cash is going to create the conditions to be able to do that. The question is, can they get it right? Can they increase rates at the right pace without, throwing the market into a tailspin? Did they push too much cash in that's going to keep pushing inflation? These are things we don't know. But the bottom line is that we know that we're in a rising rate environment because all of the macroeconomic data tends to suggest that there's going to be at least some level of inflation, and when that happens, you increase rates. So the investment themes in this sort of a market cycle, this type of economy, we've talked about this for a while now. But we really started to sort of see the writing on the wall in the first quarter here in that first slide with when you look at the S&P and you look at tech versus, the equal weight versus the Dow, et cetera. Sector rotation from growth to value. Put very simply, PE ratios of stocks are the most overvalued versus GDP that they've ever been. And that is mostly due to those big tech names. That the more sort of defensive sectors are not necessarily as overvalued. The corporate earnings are still healthy, but definitely softer than they have been. We'll talk a little bit about the business cycle. It doesn't, softer earnings doesn't mean earnings issues, but just softer than they have been. Quality over speculation. Healthy balance sheets, and more importantly, healthy cash flow are going to be key in an environment like this, which essentially means that we're looking to, as we continue talking about, dividend paying stocks. And international and global may see its day in the limelight. A lot of market forecasters have been calling for this for a while, but again, when you create all of this cash, it has the impact of devaluing your currency, which tends to be good for international investments. And then lastly, inflation fighting industries. I mean, consumer defensive. We all, remember the toilet paper supply shortage. That's a good example of that, right? So your household products, your utilities, industrials, kind of the boring stocks are the things that tend to do well in an inflationary environment. And again, even though the market is down and many of these stocks are also down, versus the broad market and versus tech, they hold up much better in an environment like this. They're kind of built for that. I'm just going to roll into the bond side unless you wanted to add anything there.
No, I'll jump in. I'll jump in after you're done there.
Yeah, and so we're actually we're pretty optimistic. We're fairly bullish, and we'll share some sort of reasons why when we wrap up. But we're a little bit more, I don't know, concerned, I suppose, on the bond side, specifically because bonds are losing their sort of ballasty properties. As interest rates go up, bond prices go down. And with inflation and rates already being so low, if you get 1% on a bond portfolio, that's a negative real return with inflation, even if it's at 2 or 3%. So we don't really think we're going to have runaway inflation, but if we continue to have even just a reversion to the trend, that's going to be a headwind for bonds. So, I mean, basically the guidance is we want to continue staying short on the yield curve. We don't want to buy anything too far out. We're looking at adding TIPS, Treasury inflation protected or inflation adjusted securities. What those do is they adjust up with the CPI. So it's an important diversifier when inflation seems to be something that will be a component of a drag on bond portfolios. Treasury ladders, owning treasuries directly, as well as actually higher yielding corporate debt, because credit spreads look fairly attractive. Even though, like I said, debt levels are at an all-time high, corporate America's debt servicing ratios are actually fairly healthy because of how low rates have been, and cash flows seem to be fairly healthy. So high yield looks like an attractive asset class. And then alternatives, looking at dividend paying stocks, more conservative stocks as a bond proxy. Rick mentioned real estate values going up, that being part of inflation, which also, they tend to pay a good dividend. So there's different alternatives that could be considered, but generally speaking, on the bond portfolios, what we're more concerned with is just the fact that they're kind of losing that ballast.
Yeah, and I'm glad you identified alternatives a little bit there, because alternatives, we're not talking about commodities, we're not talking about other types of commodity type assets.
Right.
We're looking at alternatives as in property. Sneak peek of what I'm working on at this point in time. Basically, how to value a property for rental. How to quickly value property for rental and get an understanding of what the rental can kick out and what kind of returns you can get on that. But that's an alternative to the process. But as Dan mentioned, on the ballasty side, we've always looked at the bond portfolios as ballast. So opportunity, when the market goes down, there's opportunity to unequal that ballasty portfolio, go from a 70-30 to maybe a 20 or 70-30 to maybe a 80-20. And with interest rates starting to edge up, we lose that opportunity. And if interest rates go up quickly, it could push the bond portfolios off pretty aggressively. Worse yet, I think if interest rates go up slowly, which we do believe that that's what's going to happen, it's going to shift up pretty quick in the beginning, but I think we're going to taper off a little bit. We're going to just have a long-term time frame of increasing interest rates. Basically just holds those bond portfolios back. So what we're looking at is that one, flight to quality, growth to value. It doesn't mean we're getting out of growth. It means we're hanging on to good quality growth that has good cash flows. And when you have an increasing interest rate environment, basically you have a slower growth environment. So we're not going to get those returns out of the growth portfolios that we've had in the past. So we do a shift from growth into value, and value dividend paying value, because you're going to constantly get those clicks of dividends ongoing every single quarter, and increasing dividends at that too. So we want to keep the momentum of the portfolio going, and the only way we're going to be able to keep that momentum of the portfolio going is to limit the percentage of bonds that we have in there, push them, as you said, Dan, down into TIPS, a little bit in emerging markets and international markets, and then alternatives. So the alternatives going into the real estate and things like that.
Yeah.
But so then you have another slide, I think, talking a little bit more about the business cycle too.
Did you
pop that out, or you still got that?
No, I got it here. Actually, you know what? Let me touch on this, because I got the business cycle. I just want to touch on this really quickly while we are on,
yeah.
I'm sure people are sick of hearing us talk about inflation, but while we're on the subject, the planning themes as it pertains to inflation. So most of them have to do with tax. And one thing that we have to remember, potentially one of the reasons even that we started kind of sliding into 2022 in a tailspin in the market is, most people assumed that the Build Back Better bill would pass. I mean, it was almost a done deal, and obviously then Senator Manchin voted nay, which kind of blew it up. And we're hearing now that, initially it was maybe it's going to be amended. Now we're hearing it may be broken up into different
broken up into
pieces.
pieces and
You
voted
know,
on separately.
we don't know, but a lot of the sort of the wind came out of the sails there. The point is that all of the sort of tax planning methods that we were using last year, it looks like they're still going to remain for this year. And I'm sure we'll talk about those further in other sessions and in one-on-one meetings. But one of the broad things, as it pertains to especially tax planning with inflation is, the tax code has specific items that are adjusted for inflation by law, and they're all adjusted based on, interestingly, different measures. So for example, like Social Security benefits, are going to go up by 5.9% this year. Headline inflation was like 7%, and the sticky inflation was 3.5%. As we saw, Social Security is tied to some other inflation metric.
How much is Social Security going up?
5.9%.
Say that one more time.
5.9%.
I don't think we've heard that in like 20 years.
Yeah, well, it's been like 0.5%. Yeah, so that's the thing is it's by law. It's just they look at the metric and they increase it. So all of these items you see here, the standard deduction, all the tax brackets, whether it's capital gains or regular income, 401k limits, IRA limits are not changing because the rule is that they have to go up by at least $1,000, and based on the math, they weren't going to. So they're actually the same for this year. And then the other piece is that some metrics actually remain fixed. So things like, and the one that really jumped out to me is the Sur Tax on capital gains. So they call it the Medicare Sur Tax, net investment income Sur Tax, whatever you want to call it. It has a billion different names. 3.8% if your income is above $200,000 individual, $250,000 married filing jointly. The reason it's important is because those brackets really don't line up at all with income tax brackets. So there's a lot of tax planning landmines, if you will, because we've been operating off of the current system since the Tax Cuts and Jobs Act. And with what is now higher inflation, we have certain things adjusting up and certain things remaining fixed. So there's a bigger and bigger disconnect. So there's all these sort of pockets where if you're above certain thresholds, you might not realize that you end up needing to pay that additional tax on capital gains. Or one of the things that was in the Build Back Better bill is we thought we were going to get a raise on the cap of the $10,000 deduction for state and local taxes, the SALT deduction, which New Jersey residents especially got hurt with that, with high property taxes. But we thought we were going to get an increase in that, and that remains fixed. So just things to keep in mind as we head into this year for tax planning is, a lot these inflation factors really did make a big difference. And I did put in the commentary, there was a graphic that actually showed the expansion of the brackets heading into this year,
2022.
Yeah, but we wanted to talk quickly about the business cycle, where we are, why we're still, I guess, what would you say, optimistic, bullish?
Optimistic. I would say optimistic. I wouldn't say bullish, but I would say optimistic.
Yeah,
we still believe there's opportunity. So you can see where we are. We're right here, right before, right at the end of the accelerating expansion level, and moving into this slower expanding level. And I guess when you start slowing down the expansion of the business cycle, and this, what they're talking about with where interest rates are right now and with where the economy is, that this business cycle is going to be condensed. This used to be a few years in the recovery and acceleration and then slowing expansion. And then the contraction would come. That would be, anywhere from 2-3 months to could be 6-7 months in the back in the financial crisis. I think it was as long as 9 months, I believe. But it's where once we start hitting the slowing expansion side, you start seeing a earnings growth starting to decelerate in different companies and larger companies. You start to see the yield curve flattening out a little bit. They start pushing up short-term interest rates. And depending on where the market believes it's going to go, sometimes those longer-term interest rates might flatten out. Sometimes they'll move right up with short-term interest rates. So if they continue to move up with short-term interest rates, you could see an ongoing expanding economy. But typically in a slowing economy, slowing expansion, let's put it that way, you tend to see that yield curve or that start to flatten a little bit more. Inflation, we start to peak in inflation. So again, depending on how long this position is, we could see that we could run into a little bit more of an aggressive inflation. But again, I think that's a little bit more transitory for that aggressive inflation. So we'll start to see that peak as we go into the slower expansion part of the business cycle. And then as we start to go into the contraction, then you start to see the economy slow down a little bit. And that's when things become a little bit more efficient. But I think it's going to be an interesting next 2 years, I think, going through this process.
Definitely.
Yes.
Here, and this is, I actually didn't have this in the in the deck, but I think that it's an interesting interesting look at how this is playing into the typical trend of a midterm election year.
Oh boy.
Right. So here's the deal. Right. A midterm election year. This is data going back over 100 years on average. In a midterm election year, the market, don't worry about the trend is the most important thing here. The market is almost always flat or down for the first half of the year, at least. Now there's buying opportunities, there's volatility, it's up and down, but generally it's pretty sideways. Over that, especially the first half of the year, or even heading into the last half of the first presidential year. What tends to happen is the party in power wants to stay in power, and the fiscal policy comes out, put some wind back in the sails. There's some momentum. We would anticipate that there is going to be some sort of a bill passed. And again, typically what happens is you have in the second half of the year, the market runs up. Now,
past performance is not indicative of future performance.
Right. Again, that's the thing, is the important thing to realize here is not the amount or the how steep it is. It's just the general trend. And the way that this kind of lines up with the narrative, I just think it's interesting how this lines up with the narrative, because it is typical that a midterm election year, the market is pretty sideways. It's up, it's down usually the first half of the year. Although obviously this year it's down pretty aggressively just within 30 days here.
So as we roll into our final thoughts, if anybody has any questions, you can put them up in the question and answer, and we'll go through that as we go through our final thoughts. Dan, do you have any final thoughts before we go into the takeaways?
No, I think we can stop here. I mean, we've talked about it. The market's going to be volatile. I think dealing with Fed policy expectations versus reality. There's going to be overshooting and undershooting along the way. And I think that's going to create volatility. The midterm elections are likely to create volatility. I think that we kind of laid it out. Quality, on the stock side, and being a little more strategic with debt, both in the bond portfolio as well as just in general. When you're at a debt peak, right, there's opportunities to, just as an example, have a line of credit when it's available. sort of thing, right? Because it's just a good practice during the boom times, so to speak. I think, like we said, inflation is here to stay, but the question is, what does that look like?
2%, 3%.
2, 3. Are we going to have pops? Are we going to have pockets of, transitory inflation? We don't know.
So
but
before you go, let me just touch on the market going volatility and what are we doing about that? The key to the way that we're managing the portfolios is basically we want to just protect the downside. We're not going to be able to control volatility as the market goes up and down, but if we get deeper levels of volatility, our goal is really to protect the downside and to get a little bit more into larger quality investments. And then just a little bit more into the lower cash and cash positions or short-term bond funds. TIPS is the other thing we're looking at. Inflation's here to stay. We're just, the takeaway on the inflation here to stay is we're really focusing on not expanding our bond portfolio into any longer-term corporates because that's what's going to deplete that portfolio.
Yeah.
So strategically utilizing debt, Dan, you had something that we were talking about the other day or yesterday, I believe it was, about strategically utilizing debt.
Yeah. So, well, the idea with strategically utilizing debt is that when you're at a debt peak, that chart kind of looked like it was precipitous, but it's not necessarily that way. Eventually the economy has to deleverage. So while there's debt available, we're not suggesting obviously to just keep adding to the debt pile, but you want to do things like, pull a line of credit on an asset, even if you don't use it, that while you can get it. Because the sort of the apocalyptic scenario is the 70s and early 80s happen again, and then all of a sudden, debt's unavailable or prohibitively expensive.
Debt became unavailable in 2007, 8.
Yeah, there you go.
The market cranched in 2008.
It
was completely unavailable at that
or that, which is also why we say liquidity is king. Not necessarily cash. Cash loses money with inflation, but liquidity means, short-term treasuries, dry powder to take advantage of market volatility,
Tips.
Things like that. Tips, yeah, things like that. And again, and at the end of the day too, we have to remember we are in a very favorable tax environment. The other way you can sort of quote unquote pay for this, all the money that was printed, is they could raise tax rates over time. Right. And I have yet to meet someone who thinks tax rates are going to be lower 10 years from now. Generally speaking, most people think rates are going to go up. And that would be another way, is a change in fiscal policy to create more tax revenue.
Question is, when do you believe, or when do we believe that interest rates are going to start moving up?
Well, so initially, the Fed had stated that they were going to start moving up in June, which is part of the reason that the market kind of went into a tailspin here. It looks like they're going to do their first hike at the March meeting.
Okay, so much sooner than they expected to.
That, at least that's what they're saying. That based on, and who knows, the Fed are essentially market manipulators now, because they're
come on,
really they're broadcasting these meeting minutes, and they haven't even done anything yet. And part of me almost thinks that they were putting it out there to see what happened to the market. So we really don't know until they have their meeting. But the point is that the market is reacting harshly, because initially the Fed said we're going to have 3 to 4 rate hikes this year, starting with our June meeting. So the first half of the year, we're not going to have any. That's kind of where we were at the end of 2021. Now, in the January meeting, they're saying, yeah, we think we're going to do it in March, and the market is just going haywire because of that. All over a 25 basis point increase, 1/4%.
Well, there's also word out there that it could be potentially a 50 basis point. I find it unlikely to be a 50 basis point increase, but that's the other part of the unknown, that there's some scuttlebutt out there that it could be.
Yeah, so we'll see, but it looks like, I mean, from what I'm hearing and, you know, what I'm reading, it looks like it's going to be March. So,
Okay.
yeah.
Roth conversions. Roth conversions back, let's say backdoor Roths, not Roth conversions. So originally we were anticipating the backdoor Roths going away after the first of the year. And because the Build Back Better was declined, we still have another year of backdoor Roths. Am I correct?
Yeah, correct. And again, unless they do something retroactive, which, you know, again, most of the guidance from you know, tax experts that I follow and consult with, it, you know, is that it won't be retroactive. So we should have this year to continue doing backdoor Roths and Roth conversions for that matter, because they were going to phase out the ability to do Roth conversions if you were over a certain income level. And the other piece, I mean, backdoor Roths, you know, the abolishment of that seemed to have bipartisan support. But, you know, as we said, they're kind of chopping this bill up completely. So we don't know what's going to be included now. We had an idea coming into the end of last year, and now it's sort of, they're going back to the drawing board. So, you know, who knows? We'll see. But it looks like we have this year at least.
I think what I'm going to do, Dan, is I'm doing my backdoor Roth this month, because if I do it, they're not going to take it away.
I tend to agree. I tend to agree. I'm going to stop my share here. I got another question in the box. Yeah, okay. Is there a percentage available to know how much portfolios lose as money is printed? Say over $1 trillion. Okay, so the question essentially is, do we really understand how much the currency is being devalued when the Fed just prints money like this? And the answer is no, because it's not a direct correlation. The way that it devalues the currency is through inflation. It devalues, it decreases your purchasing power. So, and that's what we're starting to see. So, you know, your dollar is worth 7% less, you know, after 2021, and, you know, we'll see what that long-term trend is, but the dollar is worth 7% less. So, you know, if we're looking for a percentage, they created $5 trillion. You know, for every $1 trillion they create, your dollar is worth 1.2% less, right? Something like that. So back of the envelope calculation.
So Jamie Dimon says there will be 6 rate hikes this year. So Jamie Dimon seems to have some insight into the future. I don't know. He was right and took a control level in 2008, 9, and 10. But not sure. You know, 6 rate hikes. I guess if you believe that there is no transitory inflation, that there possibly could be 6 rate hikes. But you know, there's too much evidence, especially when you dig deep into the supply chain, and see, you know, some of the comments that are coming out of the supply chain, that there potentially could be 6 rate hikes. And again, this is assuming at 25 basis points. And any role for gold and silver besides tips? I guess there's always a role for gold and silver. You want me to give my normal feedback on gold and silver? Gold buys the gas station, silver buys the gas.
There you go.
And if you're going to have to use your gold and silver that you have stuffed in your safe, you know, it's going to be a tough world to be living in at that point in time. The whole goal is to buy the gold, buy the silver, and hope that you can pass it on to your kids and they'll never have a chance to use it or never have a need to use it. That's the Rick Bell philosophy.
And I think so. The other thing, I think there's an argument for it more as an alternative, you know, because it is a commodity, and you know, commodity prices, you know, do go up with inflation. I don't know if there is an argument to be made that gold or silver is any more of an inflation fighter than, say, you know, holding an energy stock or something to that effect, right? it used to be the case, you know, when we were on the gold standard and that was, you know, kind of still more part of global commerce. But, you know, if you look at a chart of like the, you know, sector spider for gold, the ETF, and you compare it to inflation and interest rates and whatnot, like it really doesn't seem to have much of a correlation anymore with inflation or rates. I mean, gold has actually gone up over the last decade and rates have gone down and inflation has been near zero, which kind of doesn't make sense. If gold is an inflation fighter, you would think, in fact, the opposite.
Yeah, I think it's more of a trust in government.
Agreed.
And a lack of trust in government is when it starts to go up. But
agreed. And
oil,
I will say that I don't know if I trust that the Fed exactly knows what it's doing in this theory of unlimited money. So you know,
unless we go back onto that gold standard, it wasn't like we were off it, back on it, and then off it again.
Yeah, right. Which is also, I mean, of course, that's always a possibility. So, and I would agree that really any commodity technically should be an inflation fighter. And I think if anything, the argument for gold is more that it's sort of the default sort of knee-jerk reaction. So there may be dollars flowing into it, and by virtue of that, the price is going to go up.
All right.
Right. I don't know if it actually has any real correlation, but I would tend to think that it may move up simply because that sort of seems to be the default assumption for fighting inflation.
Right. And we're actually over our time at this point, but there's one last question about oil and energy as a commodity hedge. You want to touch on that before we walk off?
Yeah, that's sort of what I was just saying. I don't know if there's, you know, any commodity, whether it's oil and energy or gold, you know, that technically they should all be an inflation hedge because they, you know, they're almost directly correlated to inflation. You know, we'll see that at the gas pump. In fact, I think that was on your chart that gas was a huge contributor to inflation.
It is a contributor to inflation. Yeah. Yeah, actually, when gas prices went up over $100 back in 2007, it was considered inflationary, but it basically was leading to a recessionary environment quite quickly because of how fast gas prices went up.
Right.
But all right, I think we're over our time. I want to thank everybody for joining us today. Dan, I think you did a great job on the letter. You did a great job on setting us up today for our quarterly commentary. Thank you very much.
By the way, if anybody doesn't know where to get that, it is on our website. And it also gets sent out in the email newsletter. But if you're looking, we kind of follow the same cadence as the written version. But if anybody's looking to read it, whether in advance of this meeting, we send it out in advance or afterwards, just let us know. I'm happy to send it over. So,
all right.
Thank you, everyone. This was fun.
Thanks a lot. Have a great quarter ahead.